does have some splaining to do this morning, gentlemen. What a CPI print. It feels like a mirror image of what we saw back on November 14th. When we saw that the CPI beat expectations just marginally by 0.1%, and that sent the Russell and everything else off to the races. Today we missed by 0.1%, and the Russell gets clobbered. Look, there were actually some really odd components of the CPI. Apparently, the owner equivalent rent, the shelter component, went up by nearly 8% month over month. That seems pretty odd. That's an outlier. But there are nevertheless some concerning signs in there where Supercore, which is core services X shelter, is increasing. I can see Tom's eyes glazing over. So I'll just point this out that the internals of this report weren't great. Fed rate cut odds are obviously the big thing that's happening here, and it's provoking this big shift in the bond market. Ultimately, we're now seeing that a first Fed rate cut is now fully priced for July. That's a dramatic swing from where we were a few weeks ago. Going into the March FOMC meeting, the odds of a March cut were close to 94%. And so this has been a little bit of a tumble here across the bond world. I guess the question is, though, now that bonds have sold off so much, is it worth looking to buy the dip? I don't necessarily see a compelling reason thus far. There is a lot of technical weakness in a play here, and the market may need to wash this out of their system for a little while. We're also going to the second half of February here, which when you look at seasonals over the past 20 years, markets tend to peak on February 15th, and then they tend to decline for the rest of the month. S&P has averaged a 0.1% loss for the month of February, and it's because the second half of the month tends to be bad. So right now, there may be a little bit of a window here where bears can try to take control. They can try to knock us down maybe 2, 3, 4%. We've already had a decent setback today. Does that mean that the longer-term trend is up? But probably still, yes, the case. But at least in the short term right now, we're looking at a situation where there is an opportunity to trade this market on the downside.
I believe. Go ahead.
No, go ahead. Go ahead.
I actually do believe this is an opportunity in the bond market. I'm selling a little bond premium here. I'm selling some strangles with bigger puts than calls. I already bought some notes, and I am leaning. I wanted to see them rally a little bit, which they have. I mean, off their lows. Now I need dip later on today. I'll reload some of those notes. But
rally off their lows. You're talking about the bonds?
The bonds on the notes,
about 14 ticks or so. Sure.
Yeah. Now if they sell off again, now I'll buy them. Now I think there's a range in place. I wanted to see where they stop.
About the market or the bonds, because the market.
I'm talking about the bonds.
Ticks. Right.
Yeah, I wanted to see them. I wanted to see where. I didn't know if it was going to be one of those days where they're going to be down 2 points, and sure. I wanted to see where the notes stopped and where the bonds stopped, and I think at that around 118.5 on the bonds, and just under 110 on the notes. Those are pretty good areas to buy some. I kind of like it. I just sold some 115 puts and some junky calls against them. So I kind of like that trade too. We got some vol in there for the first time. But anyway, the main takeaway here is that, like we always say, everybody's wrong again. Everybody chased the bond market to the upside, and they got their face handed to them. And now the question is, how wrong will, the bonds are one thing, because bonds are a one-trick pony for us. So you're either long them or you're short them or you're just selling premium, but they're literally a one-trick pony. But in the stock market, there's 100 ponies. And the question is, is there going to be any fallover into the equity space that's any more than what we're seeing right now? I mean, AMD's down $4. Who cares? Nvidia's down $13. Who cares? When are we going to see it down? Down $130. That's what I want to know. Like that to me, the only question that's out there on a percentage basis, the bonds have had a nice decline. 3-4%. But the stock market hasn't, and some of these other stocks have not. And that's what I want to see. Is there going to be some kind of a significant, response from the stock market? Will it track the bond market? I think that's the real story right here. And it doesn't matter the reasons. Anyway, that's just my 2 cents on today's tape action so far.
The tape action, it certainly isn't pretty so far. It is worth noting that bonds after the initial sell-off have stabilized. Stocks did continue to leak lower, but bonds more or less started to chop around. And you know what? You can't rule out the possibility that this is just another event in the broader uptrend, similar to the Fed meeting itself. I mean, how much was the NASDAQ down around the Fed? Well, we had one day of losses and then we immediately bounced back thereafter because the market said this isn't necessarily a problem. What's interesting about this inflation data is that because of the differences in construction between CPI and PCE, you're still likely to see PCE come down closer to 2% here. And so there's a little bit of a gap, a little bit of a wedge right now in between the headline number that politicians and the media points to and the number that the Federal Reserve uses to make policy decisions. Is a March cut likely? No, I think you can push that back to May if you're still an optimist in those things. But I don't think this market has been driven by the need for rate cuts in recent weeks and months. So yeah, the rest of the day here today actually could be very instructive. If we're able to hold the recent lows and we do swing higher and take back some of these losses, you have to go into tomorrow with a hold on a second, maybe this isn't the end of the world type of situation. Maybe a correction doesn't occur. But again, it's that weak seasonal backdrop where if you are a bear, you have some things now going for you. The bonds have corrected to the downside. Stocks, we're back to levels that we saw less than a week ago. So it's too soon to raise the 5-alarm fire just yet. Technically, there may be some weakness and some disruption coming in, but that all needs the data settle. So if this is a print that spooked you and you were on the long side, maybe it's time to get out. If you got out already, are you looking to buy the dip? I think that's the more compelling question right now. Obviously, VIXpiration is tomorrow. We've seen this tendency in recent weeks and months that when we get to the VIXpiration, vol tends to rise the days leading into it and coming off. And if we can see that kind of mechanical churn once again on the other side of Wednesday, I think that would be another telltale indication that maybe, just maybe, this is a dip very much worth buying. If vol's not going to ratchet higher consistently and yields are going to stabilize, stocks aren't going to stay down too long.
I do give you your VIXpiration. I like the way you said that, by the way. You are right. Volatility does seem to expand a little bit towards her. Now, we are at market highs still. I mean, I know even the S&Ps are down almost 70 handles, but relatively speaking, we're still at market highs. It is the perfect storm to have a little bit of two-sided action moving forward. That's what I'm looking for. Like, I'm looking for some two-sided action. I don't think you can meet this and just say buy the dip here after where we've come from. I think you're going to need a little bit of a consolidation period where we get a little bit of bull and bear type action. And I think that's actually healthy for the market in the long run.
You know, I'm totally with you. We talked about this in overtime yesterday. You know, the period of weakness that's coming up in stocks, it really lasts from the middle of February until like the third week of March. And then you get that nice solid run where historically speaking, the market's risen from late March into July. That's why I say sell in May and go away is a nonsense expression. People are trying to convince you to sell you your stocks to them so that they can hold them while the market still rallies. So you buy through July. This is that window where there will be some nice sideways chop and consolidation. And quite frankly, if the market is able to sustain itself, not at all-time highs, but 2, 3, 4% away from them, and we move sideways, it becomes a healthy correction, not just in price, but also in time where you're no longer overbought. And then you can begin to look down the pipeline and say, okay, we've weathered the bump in inflation. The Fed is cutting rates in the next month or two. What are we really concerned about? I will say that the amount of commentary I've heard from various people today in financial media, no one is even scared of this print whatsoever because many of the expectations were we're not going to get cuts in March after that January Fed meeting. So what does this really change for anyone in the short term? It causes this dislocation here. S&P at 49.71 right now, Russell at 1985. But bonds, ZB's only down a point and 10 ticks, right? It's not like it's off 3 points right now.
Right.
And so, yeah, the seasonal weakness comes into play here. It fits with the narrative. Some chop needed, Tony. I think condors selling strangles on spikes and vol may be very appealing over the next, say, 30 to 45 days.
Okay. First of all, this is day one after a move. This is day one after a move that has been straight up for God knows how long. Mm-hmm. They look a little ugly this morning. Not gonna say there's anything pretty about this. Russell down 72, S&P's down 72. We have not seen this for a long, long time.
True.
Anything like this. NASDAQ down 2 points, and we're only 2%. We're only 21%. We're only 21 minutes into the day. I am not writing, right now they don't look ugly at all. Right now it looks like nothing. But this is how they start. And, let's see. I mean, this is just, there's a little bit of an ass whooping going on, but it doesn't mean anything yet. It's not enough. It's too early.
And you've got stocks up for their lows too. Like AMD is 169. It opened at 164.
Nvidia is only down $8. It was $8 lower than this. I mean,
Right.
There's a lot of stocks that are that are, that have come a long way off their lows that don't even look that bad here. I mean,
Right.
Yeah, this is not something where I'm looking at this going, oh my God, this is the.
Nvidia's down 10. It was down almost 25.
Well, that's kind of the point I'm getting at, because if this is like a January
I
FOMC meeting
understand.
redux, then
Yeah.
you can't get too ginned up over it. So if you were correctly positioned going into it, that's one thing. I mean, look at the damage. Nvidia's trading at prices that we haven't seen since Friday. The
Yes.
S&P is at a level that we haven't seen since last Wednesday. It's not like the Wednesday of sometime in October. This is a small setback over the course of a few days. That's why we need to see a little bit more price development. So if you're like Errol, by the way, who sold a call spread in the NASDAQ yesterday, good on you. You caught this nice tailwind. The market's moved in your favor. Don't look the gift horse in the mouth. If you're like me, who was long the call spread, well, you got some explaining to do, and that's why we're here explaining things. So tomorrow becomes the pivotal day. Will we see follow through? Ultimately, I don't know, but the price action here off the lows in some of these individual names, it's not screaming the end of the world right now. So bears may have an opportunity, but a little bit more development is needed. Tomorrow becomes that crucial day in the trend. But why are we talking about what's happening in stocks? Who cares? That's not where the money's being made right now, at least for me. It's being made in what's happening in oil, which continues to move up. Holding on to those put spreads, this remains an environment where looking for this $70 to $80 range, I think, is still fortuitous. The volatility really hasn't been in there, gentlemen. It's certainly a more appealing setup right now than anything we're seeing in natural gas. I was actually trying to get filled and jump in with Jamal at the end of last week, but I was doing it right around the close, and so I didn't get filled. I looked at the price action yesterday. I said I'd wait. There's a lot of temptation here to try to fade this move in natural gas right now.
I think everybody already is. I think every single customer I've seen that trades natural gas is long natural gas.
And yet you look at this on a technical basis and what's the rationale? Where are we finding support? Even on an intraday basis, where are we finding some stability in the market where you could take a short-term swing, even with a zero DT, and none of it's there still, or even there yet right now. So I prefer to trade crude over natural gas. I know there's the temptation to be the hero and pick the bottom. This actually speaks to a point that Anton delved into yesterday with me on Futures Power Hour, which I think you guys would appreciate. When you hear calls in the media, when you see someone like a Bill Ackman come out and say, I think bonds have topped, I'm getting short here, or bonds have bottomed, I'm getting long here, there's not just a financial incentive for them to do that, because obviously trading it can help make them money, but there's also an economic incentive, right? It's good marketing. If they make a call and it works out, then that attracts business for them. As retail traders, there's no marketing or economic appeal for trying to be a hero and saying this is going to be the bottom or this is going to be the top. You have to stay mechanically within the system that works for you. It's not going to work every time. That's why we say if it can work more than half the time and you have tight risk management, you're going to be a profitable trader. If you can get that hit ratio up to 60 or 70%, you're going to do even better. So I think there is a temptation here when you see a chart like a natural gas that's going vertical in the wrong direction. You want to say, I'm going to try to call the bottom here, because if it goes back up, I'll have the perfect entry. There's no incentive structure in place for you to be that kind of person. So stay with the trend, stay with what's working. Don't be the hero. You're not going to be on TV. No one's going to call you up and say, hey, why did you call this low in the market? We're not trying to attract clients here. We're trying to make our own money work for us, period, end of story.
Well, I also think it's kind of like, that's a little basic. I mean, that's what this whole business is about. Everybody wants to prove that they have, better vision than the next person, because it's not a strength game. It's not a, it really is a game of, people like to believe that there's people out there that have a better feel than they do, or they know something that somebody else doesn't. And I think that talking about, what the market's going to do is a big part of, that whole process. So I think it's just natural. I don't think it's, I mean, Ackman does.
Oh, no, absolutely. It's a natural thing. It's not uncommon. I think that retail traders, though, need to shift away from the mindset of I need to top tick the market or bottom tick the market in order to be successful.
Yeah, I just don't think anybody will ever shift away from that totally. But I mean, in the eyes, in the Bill Ackman and everybody else, part of they're promoters as much as they're anything else. I mean, they're salespeople and promoters, and their whole gig is, how do we? They can't be anonymous. They have to be out there, and that's their whole gig. I mean, that's really what they do. Just give me as much airtime as I can, give me as much print time as I can, and let me make as many calls as I can, and we'll figure out how to tie it all back together on the back end. It's interesting.
It's great for the hedge fund guys, but it's not a necessary mindset for a retail trader.
No, of course not. For retail traders, the way retail traders should think about moves like this is if there's something that you've been eyeballing that you wanted to get long and it's down today, like for me, it's kind of like the notes. I kind of like them in the 109 handle because I'm not interested in buying really too many equities down here, except maybe some Chinese stocks if they get super cheap. Like if BABA was to get under 70 again, or Baidu under, like let's say 100, or FXI under 22 or something, those would be really interesting to me, along with the bonds at, super cheap. But I'm not buying S&Ps on the first down day. I'm not buying Russell on the first down day. I'm not even, like, this isn't even interesting to me yet. Not even remote. Talk to me in 30 days after they've taken the market down 5 to 10%. I mean, it's a challenge one down day.
It's a challenge one down day. The January FOMC meeting, we had a loss of 1.63%. The next day, we bounced back by 1.19%. So to say that this is done, I'm not saying buy it here, but you really, if you're operating on a basis that this is a big technical breakdown, we're actually not there yet. Being a little bit more conservative and waiting for that signal to come through the pipeline to really load up on the shorts may be necessary. But if there is a flush here, guys, I mean, S&P 500, like 4850 or so, seems like a reasonable place to look for a potential area if you're aiming for something lower right now.
So I think one of the fun topics we could talk about is like, so we're down 70. Tony, we're down 72 right now. And the Russell's down 75. The Dow's down 530. And the NASDAQ's down, let's call it 290.
Yeah.
So, I mean, I don't think most people, at least based on the activity I've seen so far.
I'm a seller on rallies. I'm not a buyer.
I'm the exact same way. I'm a seller in rallies. I'm not a buyer. And I don't, and so far, I don't see anything in this market that makes me.
Now, I did close some butterflies like you had on a moment ago, too. So, I mean, like, I am lightening up on some short positions that I had that have paid me, and some that haven't. I'm hanging on.
Fine. I mean, sure.
Yeah, no, I mean, you asked, I'm telling you.
Yeah, I guess my point here is that that so far this is one of these markets where it does not scream by the dip to me.
No, but we've been wrong before, right?
Yeah, I'm wrong every day.
For sure.
I mean, but it doesn't scream by the dip. I think when you're watching at home, I mean, I'm just talking about, like, if you're trading and you're new to trading, you're like, okay, what's this big red number? Because we haven't seen a big red number in a long time. Do I buy them here? And the answer is I don't think so. I think you wait. I think it's too early. I mean, we're not oversold. That's for damn sure.
No, we're not oversold. But even a lot of stocks, individual stocks, not the market itself, have rallied back. Netflix is $3 off of its lows, just to name one. Apple is another one. It's down $2 now. It was down $3 a moment ago. So even the S&Ps and the NASDAQ making lows, some of these other stocks are off of their lows. So again, it's a trader's market, which I think is a good thing.
I completely agree with you.
Very good, sir. We good to go? Last word, Mr. Christopher?
The Knicks got robbed last night. People should watch the end of the game. Knicks got robbed.
Oh, you know what? We don't get a lot of Knick games in Chicago unless it's national. Was it national game?
No, it was Knicks versus the Rockets. But, Jalen Brunson is playing defense. Time runs out. He gets called on a foul where there's no contact whatsoever. And then the clock gets reset to 0.3 seconds. And the Knicks inbound the ball to call a timeout. And the ref says the clock expired before he heard the coach call timeout. So the game ends.
Ooh. Tibbs must not have been happy.
No. No.
I am a big Jalen.
He's never happy, though, for what it's worth. He's never happy.
I know. He was the Bulls coach.
Yeah.
Yeah. He was never happy. But I like Jalen Brunson. He's good.
He's a good. The Knicks are the baby Villanova team, right? They got Josh Hart. They got DiVincenzo. Yeah. It's actually a fun team to watch because the guys generally enjoy.
They are a more fun team to watch than they've been in a long time. All right, I'm just taking a quick look. I just bought some notes, Tony, at 109.30.
I saw it. I put it in.
First time I've stepped in. Bonds are under 118.5, so I mean we got to be getting close.
118.13, yeah. 3 ticks off their lows.
And if you're interested in buying Russell today versus anything, that spread got awfully cheap today. Russell being down way more than the S&Ps and the NASDAQ on a percentage basis.
Took back everything from yesterday and some.
Yeah, took back everything and some. So if you're interested in
It's taken back half the move from the last 3 days.
yeah, if you're in the Flotola move, that's pretty damn interesting. All right, I think that's it for me.
Thank you, my friend. Let's take a quick 90-second break. Thank you, Chris. We'll come back. We got a market measure next.
Thanks, Chris.